Paul, let me begin with you and ask you why. Is it because things are expensive on a relative basis?
That's right, and I've been around a long time, and I remember with the lashes on my back what happened when the internet bubble popped. I'm not calling that for that scenario. I actually expect the U.S. to grow at a decent rate, and the fundamentals of most tech companies, not all, to be reasonably good, but the bulk, particularly of the marquee tech names, are trading at valuations that are getting me a little scared, because I think much too much has been priced into some of these names as we roll out of 19 into 20.
Jeff, we hear that. On the other hand, I know you might counter with the fact that some of these names did get a haircut in the second half of the year. Episodes like WeWork, some argue, are healthy in the long run for establishing discipline. What do you think?
Well, I'm old enough to remember a lot of folks being concerned about tech stocks at the end of last year. And we've had quite a run this year. As you guys know, Apple's up 77%, Microsoft up 53%. And a whole class of companies on the smaller cap side that have done phenomenally well. Companies like Shopify up 200%, RingCentral up 101%, Avalara up 138%. Those are companies that people don't talk a lot about. They all focus on small business. And one thing we'd point to is the small business economy in the U.S. is really, really healthy. We did a survey of 500 small businesses earlier in September. 92% of them are bullish heading into 2020. So while I agree with Paul that valuations have gotten aggressive, we did see a pullback on some of the high growth names in the fall. You look at companies like Twilio, Smartsheet, Workday, and others that came down 20, 30%. We think those companies are primed to do very well next year and into the next 3 to 5 years.
Paul, you do name some companies that you think do have some decent upside from here. Amazon and Salesforce are among them. Talk a bit about Salesforce, because that one, I mean, I'm looking back October 2018. It was trading, around where it's trading right now. I guess in a way that is an argument for the upside you see. But beyond that, where is it? Is there a particular trend or something going on in the global economy that you think Salesforce in particular is going to benefit from?
I do, and as we continue to digitize workflows, whether it be the traditional CRM product or some of the other verticals that they've either bought their way into or have come to those markets through R&D, here's a stock that is a leader, will continue to be a leader, and despite the fact that they have done some very large and frankly disruptive mergers, including the $16 billion Tableau deal a while ago, here's a company that still will grow on an organic basis. Their top line, maybe not 20%, which has been historical, but at least 15%. And it's a stock that's underperformed the group, and it's a leader, and I think it should have bounced back in 2020.
Given what Paul is saying, Jeff, do you think that in 2020, investors are going to have to get choosier about where in tech they put their money? I mean, you look this year, I mean, semiconductors have done particularly well. You look across different groups of stock, Apple has done really well. Do you expect it to be broad-based again, or are investors going to have to get choosier?
Well, despite what we've all read in the media, large cap tech has done phenomenally well this year. You look at companies like Google and Facebook, Microsoft and Apple, obviously, as you mentioned. But I think when I talk to folks that are looking for undiscovered gems, I'd point to the SaaS category, which, as you guys mentioned earlier, did have relatively high multiples this summer. But these are companies, if Paul likes Salesforce, he's going to love Twilio, he's going to love Zoom, he's going to love Slack, he's going to love Smartsheet. These are companies that have net dollar retention numbers that are north of 120, 30, 40%. So when they start the year heading into 2020, they know their organic base of business is going to grow 30, 40% year on year. Plus, they're going to add in new bookings to new customers. So we love those names, and we love that category of high-growth SaaS companies with strong net dollar retention. It's also a metric that public market investors are starting to look for, and companies are increasingly disclosing.
So, Jeff, what's your monkey wrench scenario there? You're overall pretty positive, but what potentially happens in 2020 that derails that thesis?
Well, obviously, we have an election coming up, as you guys know, and that always has an effect on the market. Obviously, global trade has had some impact this year, although hasn't been negative on companies like Apple that we all thought it would be. You know, the one thing I'd say that's changed in our world in the private tech markets is obviously WeWork and some of the challenges there. And so as you look at high growth, low margin companies, those that really weren't built around a pure technology offering, we are starting to see some challenges there in the private markets. Now, whether that plays out in the public markets, TBD. But if you look at the internet sector broadly, you know, this year was a record year for IPOs, the most capital raised by IPOs since 2014. Software IPOs did very well, up 38% on the year. Internet IPOs not so well. Uber has struggled, Lyft has struggled. WeWork obviously didn't get out. And so we look for that trend to potentially continue while demand for software companies and high margin companies continues to be really strong.
Paul, I'd love to get your thoughts on private money as well. Axios has a piece out today saying even after WeWork and the collapse and all the social media predictions that today, their one report today, 23 new deals totaling over $1.1 billion. What is the calculus behind that? What is VC seeing?
Well, they'll continue to pour money in. The problem with some of these VC funds, if they've raised a lot of money into these funds in the last couple of years, and it's burning a hole in their pockets. And so sometimes they're forced to get invested to go after some really stupid stuff. WeWork was one of the examples. So I think what happens is you'll continue to have some deal flow. Hopefully it's more modest deal flow with some reasonably priced companies. But I also see an opportunity. How about some of these broken IPOs of the last year, like Pinterest, for example, Zoom, for example? You might be able to get some reasonable companies that are now going from loss-making to revenue acceleration and making some money. I think those, as when you talk about IPOs and private to public, those might be our opportunities in 2020 to pick up some of the poor performing sensor IPOs deals of 2019.